Hi guys, welcome to my YouTube channel, and today I'm going to show you how to trade synthetic indices, or I'm going to show you a beginner's guide on how to trade synthetic indices from the beginning to the end. So stick until to the end of this video in order to get the whole experience and get to know the synthetics market. If you haven't liked, subscribed, please make sure you hit the subscribe button, make sure you like the video, make sure you share. So as you can see here, I have a beginner's guide on how to trade synthetic indices profitably, and we are going to start. So for those who don't know synthetic indices, as you can see from this point, synthetic indices are financial markets that mimic real world market behavior but are not influenced by actual market events like news or politics or gaps. So once you get into this market, it is completely, you see, as you can see from this point, they run 24 hours a day, 7 days a week, 365 days a year, including weekends and public holidays. So this is a market that is open every day. So there is no day that you are going to wake up and say that the market is not open, that you are not going to have any position. So the market is open on weekends, it's open on weekdays, public holidays, and whatsoever. Unless otherwise, they usually give you an email to your phone that they say that a specific day they are not going to be available. So you should not trade during those days. So yeah, as you can see, they are available to trade 24/7, 365 days. You can trade them anytime. As you can see, it offers deep liquidity, predictable volatility. They also offer tight spreads. The spreads are like this much. Yeah. So once you get into a position, you directly go into profit if you are right about the market that you are predicting. So it just shoots. So as you can see here, they also offer no negative balance, so you can never lose more than you deposit. That's basically about synthetic indices. As you can see, the synthetic indices are exclusively offered by Derived. So you can never find these indices anywhere else on other brokers. So only on Deriv. So if you want to trade these synthetic indices on Deriv, I have a link in the description of this video. So make sure you go there, hit that link, create an account, and I'll see you on the other side. So let's get into it. As you can see, once you can start trading, that is as little as $0.5 per trade. That is on options trading. So on derivative offers that you can trade on options and you can also trade on CFDs. So once you open your positions on options, you can open with as little as $0.5 per trade. And once you open a real account, you can trade with as little as $5. So the minimum deposit that you can deposit on Deriv, you can deposit as little as $5. As you can see, you also get access to a free demo account with $10,000 in virtual funds that you can reset anytime to test your trust strategies and everything. You also offers leverage, as you can see here, of up to 1:1000 in CFDs, that is contract for differences. But as you know, leverage is a double-edged sword. The more money you make on leverage, the more money you are going to lose if the position is against you in the market. So you should always use this responsibly. So yeah, so let's get into the next one. As you can see, in synthetic indices there are different types of synthetic markets that you can trade in deriv. I have a bunch of examples here. You can see it offers volatility indices, switch indices, jump indices, range breaks, boom and crash indices, DEX indices, and also step indices. So the ones that I'm going to recommend you to start with are the volatility indices or the step indices. Mostly my case, I normally prefer trading the step indices. These are, they move in movement of 0.1 to 0.5 per tick. So what this means that if I set a stop loss or a take profit of like $20, once the market comes and reaches at that point, I'm only going to lose the $20 that I put in. I'm never going to lose much more than $20 that I was willing to risk. That is, and so the best thing about this market is that even when like the other markets, when the price has those sharp drops and those sharp drops, or we say for example when it's in an uptrend, it is having those sharp up moves. You find that you say for example you had like a 20 pips top loss or a $20 stop loss, the amount that you are willing to risk. Once the price moves those like shoots up, and you can see that it moves like 10 pips, you get that you are losing like $25, and in the stop loss you had actually put $20. So that difference is what I am trying to avoid when trading these ones, so that in case I put in that position, I put in $20 that I'm willing to risk on that trade, it's going to take me out. Once the price goes against me or it decides to go and take out my stop loss, I'm going to lose only the $20. I don't know if you get me. So yeah, that is another thing you might consider before you know what you are going to trade on the synthetics market. So let's get on. As you can see here, I have a table here that explains the two main ways to trade synthetic indices on derivative. You can trade synthetic indices on digital options or as option trading, or you can trade them as CFDs. This is called its contract for difference from this point. And as you can see from this point, this is the table. As you can see, digital options, you have fixed. This, you only lose the stake that you have put in. So if you put in $1, you are risking $1 in that trade, so you're going to lose only that dollar. That is the collateral that you're opening a specific position. So yeah, this one is fixed. So in terms of risk, as you can see, this one, your risk is fixed, and in CFDs your risk is variable. This is if you are in a buy position and the market is moving to the upside. The more the market moves to the upside, the more profits you make. So yeah, in digital options, the more the market moves, it's only going to the amount that you are going to be paid out will be fixed, and the stake, if they say that the payout is like 96% of what you risk. If for example you put in like $1, you're going to be paid 0.96 cents basically for even if the markets move, as long as it's on your side that you predicted, the price will only be $0.96 if the payout was like 96% and everything. But you see, the good thing about trading CFDs, it is variable. That means the more the market moves, if the market moves like crazy, like 120 pips or even 300 pips, the more money you are making. So you see, and the other thing you can see from this point, expiry. In digital options, they have a certain duration to expire, but in this one they have no expiry date. Like you can open the position today and decide to look like you're going to close next week, or once you come, you see the profits are good and you see the market is reversing, you have an option to exiting the markets and everything. And the next thing, as you can see here, it's in leverage. This in digital options, it's always fixed. Everything is like fixed. But you see on the CFD side, you have the option of changing leverage. You have up to 1:1,000 in leverage. That means if I have $1, I have about $1,000 in buying power or in selling power to open positions. How cool is that? But I said on the leverage, you should always use the leverage responsibly, because it can be good and it can also be bad as well. So make sure you take care on that, or you check on that, because it can also be a double-edged sword. Those who don't know that know what I mean by that. And as you can now see in the profit style, in the digital options, we have a fixed payout if correct, and on the CFDs it's point based. And the more the market moves, the more profit you make. So yeah, and as you can see, the best for beginners is options, but in my opinion, I don't see why you should do options. But for the more advanced, for this one, for CFD is best for intermediate, or people who have flexible strategies, or in these markets, it's a crazy market, and sometimes you might come today and your strategy is not working because it worked on another pair or on another market. But once you come here, you need to have flexible strategies. You might wake up one morning and you see that your strategy is not working, so you need to adapt to that. So you need to have flexible strategies. And so yeah, let's dive more deeper into CFD trading. So because this is where you are going to be focusing more, or this is where the weight of the lesson is going to be from here. So this is the foundation. So we are going to be focusing more on the CFD side. So we are not going to be focusing on these digital options. But if you want to focus on digital options, well, you can do as you please. But in our case here, we are going to be focusing more on the CFD trading. So let's get into CFD trading. Boom, as you can see, the CFD, or the contract for differences, they let you go long or short. If you can profit in any direction. So as long as if the market is buying, you buy, you are profiting from the market. If you sell, if you are going short or you are selling and the market is selling, you basically get profit. That's how easy it is, as you can see from here. A contract of difference, lets you speculate on price movements without owning the underlying asset. You profit from the difference between the entry and exit price. So let's say, for example, as you can see from this point, let me get my pen. As you can see, there is this market. let's say you opened a position from this point. You want the price to go up, right? The market is going up and you had your position over here. Let's say you had your position over there. This is the position. Then you had your stop loss below here and your take profit below above here. Let's say. So the price is moving to the upside. Okay. So as the price is moving up, you are going to profit from the market because you bought from the market. In a similar case happens when you are selling. Let's say this market is going down. As you can see from this point, the market is trending downwards, right? Now let's say you open a position in this point, your stop loss above there and your TP above or TP below there. Now the price is moving down, you see. So once the price is moving down, you get to profit. You can see, as you can see from this point, you see, going long, you believe the price will rise. As simple as that. And going short, you literally believe the price will fall. As easy as that. It's nothing easy as that. Now all you need is a strategy that is going to tell you when to buy, when to exit the market, where to set your stop loss, where to sell, set your stop loss, your take profit, and that's it. You are good to go. So as you can see from this point, you have an example from this. Let's say for example you buy at 88 and then you sell at 88. That's a 10 points. You see, from this 0 to a 10, so that's a 10 points gain. So 10 points gain, that is equals to $1. Or 1 point is equals to $1. So it's 1 by 10 points. So that is going to be equal to a $10 into profit. The same with selling price. You see, you sell at 900.00. The price goes back to 890.00. So you have a 100-point gain. Each point is $1. So $1 times 100 points, you get 100 pips or $100 in profit. As easy as that. And as you can see here, you have a rules of leverage, and I had explained that. As you can see, the leverage lets you control a large position with small capital. For example, if you use 1:10 on a $10,000 controls a $10,000 position. So the same way I was telling you, if you have a 1:1,000 leverage and you have a dollar, so $1 times 1,000, you can control a position that is at $1,000 with $1. So what does this mean? This means that you can make a lot of money, and you can also lose a lot of money as well in these markets. Meaning, if 1% move in your favor, if you are using this leverage over here, 1:10. So if 1% move in the market moves in your favor, that will be equals to $100 in profit. That's a 10% return on your capital. Yeah. Now, if the same one moves against you, you're going to lose the $100. That is why the stop loss comes in. So always make sure you use your stop loss when trading and everything. So let's get into the next one. So as you can see, I'm going to show you the platforms that you are going to be trading in this in these markets or the synthetics markets, because these synthetics markets are not offered anywhere. They are offered exclusively on the reef. You're not going to find this on any other brokers. And yeah, so what you need to know about platforms that offers the CFD trading on the reef. So one of them is, as you can see, one of them is this Deriv MT5. You also have Deriv C Trader, and you have TradingView. You can view this market from 3 platforms. You can view them from Deriv MT5. This is where you trade from. You can trade it from your, it is available on the web, desktop, iOS, and Android. Are we together? C Trader. This one is advanced platforms for experienced traders. And in our case, you are going to be dealing with this and this trading. So in our case, we are going to be using C Trader and TradingView in our case. Now, we have types of orders in the trading or in trading. One order is the market order. So what does market order do? So this is where the market, you come, you analyze the markets, you see the conditions are great, and you are already seen an entry. So once you click buy or sell, the market will automatically get you into the market at that specific time or the exact time that you clicked the buy or sell, or it will instantly get you into the markets. Now on to the next. We have a buy or sell limit. Now let's say you did your analysis, right? Let's say the market, you see the market is going up, down, up, down, up, down, up, right? Now you see there's a potential of market coming back to this point because we are on an uptrend. So right, so now you can come here on this buy limit. So you put your buy limit order over here. Now once the price comes, once you put your buy limit order over here, you put your stop loss below there and you set your take profit. Even if you are not on your screen, the market, when the market will come, let's say for example the market comes back for a pullback, the market is going to come back, touch on your order, it's going to get you into the market, and then the market proceeds to the upside and until it reaches your take profit. And once it hits your take profit, your profits are in your account. And once you get back to the charts, you can find the position has already worked out in your favor. You walk away with profits as you see a start. Now, what happens if you get into the market? You go, the order gets triggered and it hits your stop loss. The same thing that is going to happen. So the market is going to come. Once it reaches here, it gets you into the market, but it goes. It's going to stop you out of where you set your stop loss. So it's not going to, it's not going to use the whole amount in your account in order to, the amount you set on your stop loss. Let's say for example you set your stop loss at a $20 loss. It's going to stop you out at $20 and not more than that. And yeah, if the price continues to go down, it is going to go down, but you're going to lose only your $20. That's it. So that's the cool thing I like about that. Now you also have a buy stop. This is another order, a buy stop or a sell stop. So this works like this. Let's say the market is moving to the upside, as you can see, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So now, as you can see, the market is moving up, down, up, right? So now you see you're in an uptrend. So we know that this point in order to create an uptrend, this point needs to be broken, right? Now, the price, let's say the price is almost here. Now it's going for the pullback, right? As the price is going to go back up, you put your buy stop order over here. You put your stops below this point, and then you set your take profit above this point, right? Now, as the price is going back up, it is going to come and pass at this point where you set your order. So it's going to trigger your order once you are in the market, and it's going to go on until it is going to hit your take profit or otherwise. So yeah, that is how basically these orders work, right? Now you also have these two orders. You have your stop loss and your take profits. These ones are the ones that I have showed you. They are for protecting your capital. So you can set them once you put your position. And I would advise you, if you don't know where to set your stop loss, kindly do not get into the markets, because when getting to the markets, you need to have your entry, your stop loss. You need to know where you are going to put your stop loss. You need to know where you are going to exit, or where your take profit is going to be. So if you don't know those things, I would suggest you stay out of the market. So before you do any analysis, or you are doing your analysis, make sure you know where your stop loss is going to be, make sure where your take profit is going to be, and your entries. Please master them. Please. And the next thing that I like to share about trading or on the order types is your lot size. Your lot size matters a lot. As you hear people saying, you can have a lot of money, but you don't know how to utilize the lot sizes. And those people who don't know how to use with the lot sizes, they are not good with with risk management, mind you. Because you get someone is having like $1,000 account, and he's risking like $500, and he doesn't even know he's risking like that $500. He just goes into the platform, opens an order, types in 0.1 or 0. Or one order, or one lot, 2 lots, 3 lots, 10 lots, and even doesn't know how much he's risking. So risk management is key in order for you to succeed in this trading, mind you. Yeah, and if you don't know how to, if you don't know risk management, my friend, I don't think you should be in this markets. You are literally like gambling, my friend. So I would advise you to do the necessary and at least master risk management, because risk management is the key. Now here's a tip for you. MT5 trading platform is the best platform for beginners, but according to me, I said I prefer using CTrader and TradingView for my trading and analysis. So yeah, but most of you I know prefer MT5 trading platform, and so I recommend it is the best for beginners. Let's get into the next one. So I also have come up with 10 rules for every beginner, or for every beginner must follow in order to succeed on these markets. These markets, or the synthetic markets, one of them, start small and build up. So use the power of compounding. So this rule is really strong. 1% daily equals 34 times a year. So every day in the market, when you come, make sure you follow your risk management. Never risk more than 2% daily. I would also recommend you 1%, minimum is 1%, maximum is 2%, right? So number 2, you can trade both CFDs and options trading, or it's called diversifying your approach. What do I mean by this case? Now, in options trading, you have what we call a fixed time frame, or they have expiry dates. What does that mean? Now, let's say in the CFD, you have seen an entry at, let's say, step 200 index. Now, you're in a buy, right? Now, you go on the options trading on the same instrument, the step 200 index, right? And now you enter a position with a certain amount of stake, and you say it's a call option or a put option. Let's say, for example, in our case, we already put it's a buy on step 200 index, so it will be also a buy on the options side. So you buy, right? Now, if the price goes on in your favor in the CFDs, you are profiting, and the same also on options. If the price is buying and it continues to buy, you are also making money on both sides. And so, yeah, that is also, you should also consider that. You can also diversify your indices. As you can see, I had already talked about that. You should have at least 2 to 4 different markets, and I would recommend you stick to two, and you trade this. If it's not good, you switch to the other one. If you don't have a setup on the first instrument, you can switch to the second instrument and everything. So now rule number 4, you should always plan your exit before you enter. Before you enter any market, you need to know where you're going to exit. You're not just entering randomly. You need to know where you're going to put your stops, where you're going to put your stop loss orders and everything. So make sure you follow that. Before you enter any market, you need to make sure you know where you're going to put your stops and where you're going to put your take profits orders. So yeah. Rule number 5, always stay focused. Avoid information overload. As always, simplicity beats complexity. So you should always keep your charts as clean as possible. I would recommend you use like maybe 1 to 2 indicators. The rest, just leave them. That will be overcomplicating your work. So keep it simple. No information overload. Avoid information overload at all times. Yeah, keep it simple as always. Rule number 3, always have a backup device. Now, I cannot emphasize this enough. And always have a backup internet connection. The Wi-Fi can cut at any time. So you need to have an option of having a backup device that is always, you can get into the market and confirm. If you see the market is going, against you, you get the opportunity to, exit the market. And yeah, now you also have this one other one. Rule number 7, constant and never-ending improvement. Keep learning every day, by the way. So as you can see, even right now, I'm also learning. The more I read, the more I keep learning every day. So you should never stop learning. The markets are evolving, so you need to evolve with the market. So once the markets are evolving, you should also update your knowledge. So you should never stop learning. You should keep learning every day. Now rule number 8, always use a demo account. You can use a demo account to backtest your strategies. Maybe you have multiple trading strategies and you want to backtest them. You can backtest them completely for free using demo accounts. So always Rule number 9, always keep your emotions in check. No fear, no greed, and always stick to the plan. Always have a plan when you get into the market. As you can see from this point, you already said you should always have a plan, before you get into the markets. And now, you should always keep your emotions in check and always stick to the plan. Now, this is where, even if the market is going against you, you should never make hasty decisions. You can see like, oh, my stop loss is almost being wicked out, or I'm almost being wicked out, and so you decide to hop into the markets. But once you see the market is almost near your stop loss, but you end up losing the position, the market ends up reversing, and it goes back up, and it goes straight to your take profit, and you're like, man, I should have stayed, man. Stick to your plan, man. Number 10, and the final one, always review and learn. Analyze every trade. Success is a marathon, by the way, it's not a sprint. So always analyze every trade. Success is a marathon. So once you finish trading, or if it's a loss, if it's a win, always make sure you analyze it. Make sure you know where you went wrong, so that in the next time when you are doing the analysis and everything, you should never repeat the same mistakes. And so, yeah, in conclusion, let's see, summing up all that. Now I'm going to show you the essential platforms that you are going to be using for your trading. So you are going to be using Derivative Trader. This one is for those people who are going to be interested in options trading. MT5 for CFD tradings, and you can use Derivex, but Derivex for now it's not available, it's only a trading view. And you can also use Derivbot for automated trading. Now on this Deriv MT5, I'm going to add CTrader in this, because it's the one that you are going to be using. It's also available on web, mobile, and desktop versions. So yeah, learning resources, you can get learning resources from the following platforms. You have first Deriv Academy. They offer tutorials, webinars, articles, and ebooks, so you can definitely check them out. They offer those. You have a Deriv YouTube channel. They also have the Deriv YouTube channel, by the way. They have video walkthroughs that they can take you through in order to learn more about synthetic indices and everything. We have TradingView, free chatting and community ideas. You can get there. The TradingView community is also there. You can, go there and get their insights and see how they analyze the markets. So yeah, now your five-step action plan for you to start trading in 2026. First, open a free demo account at derivative.com. If you don't have an account, I have already linked the link in the description below, so make sure you click that link. Make sure you sign up for an account with derivative.com. Now, second, explore indices and practice with virtual funds. I cannot emphasize this enough. So first, go do your practice on the demo account before you put in real capital. Number 3, learn one strategy and test it thoroughly. I can also not emphasize this enough. You can learn one strategy, test it thoroughly, and it is going to pay you for the rest of the year. Yeah, mind you, every time it works, it's possible. And it is only possible if you only focus on one or two pairs. So you get to learn one strategy, to master it, and see if it's working on the foreign pairs, or it is working on the foreign instruments. Let's say, for example, step index 20 or step index 200. That's what I mean. So you can open the market and you can only trade step 200 once all what the strategy that you are testing is offering. You can enter into the market Now, on to the next. Open a real account with the Solito as $5. As you know, once you create an account, once you have already practiced in the demo account, and you also have a strategy, you are ready to fund. So you can fund with as little as $5. You can deposit as little as $5. If you know, you know. Now, you start small, grow steadily, and never stop learning. So once you create that account, I'm going to see you on the other side.